Thanks a lot, Nikolai, and thanks for CVVC for having me to moderate this panel. I would like to introduce quickly the panelists and the companies they're representing, and then we will dive into the first few questions and topics. So we got Josh and Tian Tian from Amber, Jacob from GSR, Darius from QCP, and Anton from Flowtech. So quite a few heavyweights in the liquidity providing and market making space. Thanks
Patrick,
for joining, guys.
It's Josh here from QCP. Darius is not in today.
Okay. Sorry.
Sorry to disappoint.
Sorry for that, but thanks for the correction. So let's jump into the first sort of topic here. The increased volume, not only in dollar terms, but also in in amount of tickets, is quite an infrastructure challenge for most of you guys, I guess. So I just want to put it into the panel round now. How do you cope with it, and what are the ideas and solution you're trying to look out for to overcome that hurdle? Maybe Tian starts.
Yeah, sure. Hi everyone, this is Tianten from Amber. We're a crypto finance company out of primarily Asia, and an active trading participant and market maker in the space. So with regards to the question on sort of constraints that market makers face, given higher volumes, I think the most immediate answer I can give is probably related to things like API rate limits. In sort of simple terms or plain English, it basically means constraints on how many orders one can send per say every second or every 10 seconds or 100 seconds or what have you. I think overall I think it's helpful to maybe take a step back and think about I suppose kind of the root cause of why this problem exists for market makers. And I think at its core, essentially because most exchanges, like we use the word exchanges, but what they really are, they're websites where the matching engine is hosted on a cloud server somewhere, and most of these platforms are not really built for institutional use, right? If we rewind like 2-3 years back, I don't think anyone really back then could have pictured the kind of scale and size of today's current market. And so they were built for retail use. And so as volumes have increased across the board, so has the need for higher throughput on these exchanges. And so we are seeing exchanges kind of tackling this by revamping their matching engines in order to sort of overcome this technical overhead. With regards to sort of solutions, I think many exchanges now they offer things like batch orders, where instead of like sending and updating like an order, or let's say if you posting bids and offers in, call it BTC USD, instead of putting up 5 bids and 10 offers and updating each price level sort of independently, one can kind of send a bucket of orders in sort of one batch. And so that helps alleviate some of these concerns. And I think to add on top of that, most exchanges now are also pretty sort of commercially flexible. And I think this is because they have realized that, if you look at sort of the exchange volumes and revenue breakdowns of where they're actually making their money, right? It tends to follow this sort of Pareto distribution where, 80% of their volumes make up, or rather, 80% of their volumes come from like the top 20% of clients. I know all of us on this panel are trading quite a lot every day. And so it makes sense for the exchanges kind of to offer more flexible terms for market makers, which do pay a significant amount of fees to the exchange. I think though that sort of the overriding trend is not, it's not kind of volumes themselves which change anything, but rather looking at how these volumes are now dispersed. We now have not only a wide variety of sort of spot instruments, but also futures, perpetual swaps with different, there's stablecoin margin ones, and there's coin margin ones, altcoin futures, and the rise of crypto options as well. And I think all this gives rise to more hedging venues and new strategies one can sort of deploy across these. Yep. And I think that's sort of one of the bigger trends we're seeing.
Okay, thank you.
It's Josh here from QCP. We're a market maker out of Singapore, and agreed with everything TT said above. I'd say, if I'm able to offer some commentary, our business is a little more OTC and off exchange focused, and our color there is more geography specific. I think us being focused on local markets, especially here in Southeast Asia and Singapore, Malaysia, Thailand, Vietnam, Indonesia as well, the take-up rate's a little different. The adoption there is still very much off exchange, and our increased volume, which we've seen throughout this period, in spite of COVID and everything else happening, our volume issues are usually related to pure balance sheet allocation and crypto fiat rails. That's still, I think, maybe a step before even thinking about the on-exchange stuff. Our on-exchange activities are a little more focused on the prop business, but our initial entry into these markets has seen mostly people looking to do capital outflows, places with the old story of capital controls, but still there. So, in coping with that, we kind of had to match up our internal tools to allocate and manage relationships better, to know how to manage those settlement times, and seems like a problem from 2017, but it's still there. And I guess the encouraging thing is that these markets are still kind of in the adoption phase and take-up phase, and starting to use Tether and stablecoins a lot more. So for us, it's become apparent that there's different adoption rates across the stables, and the way we rebalance across those has become a pretty interesting problem internally. So a lot of internal tools to deal with that.
Yeah, absolutely. The liquidity management point and the balance sheet point will be one of the next topics then as well. Going to be interesting to hear your take. Maybe Anton from Flowtech, who's one of the let's say special candidates here on the panel. How do you cope with the technical issues here?
Yeah, so just to provide my background, I'm a former high-frequency trader in the foreign exchange markets. Then I ran a digital asset exchange here in Switzerland, 100,000 plus clients. Also issued one of the world's first security tokens, was actually traded in the secondary market. And kind of Flowtech is the result of that, my experience, kind of the need for liquidity. And kind of if I see the market structure in the crypto world and reflect what I've seen in the traditional world, and also when you run an exchange in the crypto world, what you kind of realize is the matching engines were never built for situations where you have potentially, hundreds of thousands or even millions of clients that directly have market access. This just doesn't exist in the traditional world. You have exchange members, and then through that exchange members, you can have direct market access, and then we have a very narrow pipe that goes into that matching engine, And kind of what we see firsthand is that when you have the opposite situation in the crypto world, it's just the matching engines are not built for that. And kind of what we see is whenever you have a bit higher volatility in the crypto world, in terms of the market movement, I mean, basically we hit the rate limits, probably like all of you guys, quite often in that context. And, the latency and the corresponding slippage that we incur because of that is just quite, it's just a painful experience for us, just to be kind of very transparent what we see out there. In terms of now looking on the market structure in the traditional world and the crypto world, the question is then, will we actually then have exchanges? Will we have exchange members and then they only can touch the matching engine, no one else? And here I'm actually quite surprised that that's not the case kind of yet. If I have to say, what I see a bit different scenario is actually exchanges focusing on institutional traders or institutional investors. I think a candidate for that would be LMAX, that pretty much doesn't have retail clients at all. And there kind of the infrastructure is actually quite solid. They have fixed protocols and everything kind of that we will be familiar or used to coming from the traditional world. But kind of we definitely see the complexities, around how the exchanges are built. And kind of my experience is that a lot of them are built by full stack developers, but not by engineers that have experience, with matching engines. And I really also want to reflect actually on what was mentioned before, is that on top of that, those exchanges are kind of built more like a brokerage platforms, because you have the custody at the same time, the settlement at the same time, the matching engine at the same time. And this is really not how the world will look like. And what we see on the regulatory side, I anticipate that there will be a pushback from this kind of like altogether setup, and they will actually start segregating. And we even see that, also kind of looking at how custody is being now taken out from the exchanges. There's a more and more vision actually going the direction that you'll have different building blocks around it, and then matching engine will be one part of that. So this is kind of my input around that.
Cool, thanks. That's definitely a topic as well. Then later on the regulatory environment side, that these exchanges will get sort of split up in different blocks. Jacob, how do you see the technical hurdles? How you manage it on the GSR side?
Yeah, I think we agree with what's been said so far. We covered a lot of the challenges that we face. I'd say, comparing how it is to integrate with these trading venues today versus 3 years ago, they have made a lot of headway. I think, as it is with any trading technology, you should really focus on building it for performance and robustness. And one way of thinking about it is that if you have your own trading system, what you tend to do is that you tend to scale it up to a bit, and then you tend to consolidate to make sure that you test the throughput that can go through that system. And once you're comfortable with that, you go to the next step. Here in crypto assets, we just continuously go on this exponential increase all the time. So we keep hitting these bottlenecks, and it's mainly due to increased throughput, which is very hard to model. It's very hard to model to make sure there's nothing going wrong, if it's getting the right partial fills all the time or getting the feeds right. Things will happen. Rate limits, which TT mentioned, is very important. I think that having those negotiations enable us to do our job, but cancel and disconnect is critical for us to have from exchanges, because we know they're going to go down, and once that happens, we need our orders to go. So we don't expect these exchanges to be as robust as in traditional finance, but we do want to see them moving towards that and having that ambition, we hope they will continue to make strides towards that.
Thanks a lot. It's quite refreshing to listen to people who actually know what they're talking about, because it's quite funny when you talk to customers or institutionals who want to get into the crypto world. They just think they can press a button and then an order gets executed over the next 6 hours on a TWAP, and everything goes fine and no disconnect and no nothing. But it's something that we probably need to show the institutional world that crypto is still in the development phase, and as you said, in an exponential growth phase, which is very hard for infrastructure and software to keep up with. On the second part, liquidity management, which is as well for us quite an important point. And every time when people ask me what do you miss the most in the crypto or in the crypto trading ecosystem, then I always say balance sheet. It's the one thing that is quite hard to get, and we touched on a few things already with settlement cycles and different fiat ramps and different coins and stable coins. And I would just like to throw it into the round again, how you guys feel it, or what is your sort of solution to that kind of bottleneck? If we're gonna have this next push through the $20,000 barrier, more people will try to trade it, and it will get even more scarce, the balance sheet, I guess.
Yeah, I guess I can take a stab at this. So I think if we were to take a step back and like think about why balance sheet matters, and I think this is kind of goes back to what Anton was alluding to earlier. In crypto, exchanges are kind of they're owning the entire stack at the moment, right? Where they're the broker, they're the clearinghouse. Sometimes they're also a market maker themselves. Whereas in traditional finance, you usually have a separation between the kind of trading, settlement, and clearing function. Whereas in crypto, that doesn't really exist, and we don't really have any true sort of prime broker or clearinghouse yet, where I can net off my my positions, right? So if I buy instrument A and sell instrument B against it, or rather I buy instrument A on venue 1 and I sell instrument A on venue 2. Even though I'm risk neutral, I got to put up the same sort of collateral twice, and so that becomes a very balance sheet intensive exercise. But with that said, I think the credit markets have grown a fair bit over the past year, partly because I think rates in, I guess, the real world are tethered to zero, and so a lot of capital has flown into crypto via the rise of these kind of retail-based lending platforms, like the Celsiuses, the BlockFi's, Nexos of the world, where effectively they're promising interest rate to the user, and they go and kind of rehypothecate or lend that out to market makers. And so the growth of those markets have also meant that market makers kind of access to capital has become easier. So that sort of alleviates some of these concerns. But with that said, I think what would be more interesting to see is if any custodian could potentially fill the role of, let's say, this sort of central clearinghouse where I have my coins in sort of one place, but I can sort of use that as margin across multiple venues. I think there's a few custodians which are working on this. Copper, I think we don't use them, but I know that they have a solution that's trying to do this. I think Fireblocks is working on the same, and I think BitGo has tried to do this as well. But it's a bit of chicken and egg, because market makers want this, but exchanges are not that keen to opt in and give up sort of control of custody either. So, but yeah, I think that's a space which is going to be pretty key in the future.
Yeah, thanks a lot. Yeah, I fully agree on that one.
Yeah. I agree with. Sorry, do you want to go, Josh? Go ahead.
All right, yeah, I was going to say the stablecoin adoption rate has also been a pretty interesting factor here. We kind of face a lot of the regional flow, and it's pretty interesting to see how USDC has kind of taken up a pretty solid foundation in local markets like Indonesia and Malaysia and Thailand as well, competing pretty heavily with USDT. And that kind of has implications for us in terms of both printing, redeeming, and our trust in holding those balances to begin with. And then for us, that's kind of layered against having to deal with some of the more inefficient local banking rails. So kind of a repeat of my last statement, but similar to what Tian said, we're kind of dealing with a slightly more primitive caveman style problem here, where moving that balance sheet, between some of these markets can be an enormous challenge, but sort of therein lies the value as well. And at times we are forced to turn away flow because they're asking for certain stables that we just can't provide in time, or we're just not willing to front the balance sheet for. So it's a growing space, and for us, that sort of niche stablecoin competition is a pretty interesting one. But we think that some of this is going to consolidate soon. We're actually seeing a lot more of the activity go to USDC these days, and we're seeing other market makers consolidate their holdings there as well.
Thanks, Jacob.
Yeah, I agree with what's been said so far. Part of it is as well that we are, we are dealing with some of the time constraint and operational constraints of traditional fiat when we are working crypto versus fiat, and that creates some mismatch because the legacy system is slower than crypto tends to be. We've done a lot of cross-border payment solutions, whereas sort of the idea generation or the build out is one part is technical, so you make sure you have your hedges everywhere, but part of it is just having the right relationships and the timing right, so you actually can create this workflow. I guess the other part that we have experienced is that as the derivative markets has expanded, the need for a treasury function within market makers and also within issuance projects or anyone focusing on crypto has become a lot larger. Understanding your funding rate and especially during times of expiries, for example. Somebody like GSR, our balance sheet requirements can expand vastly because we're very active in the options and derivative space to then go down. So what Titi is saying, working with people like Copper and the likes to develop these more prime brokerage or clearing functions, and being able to have that access to balance sheet and cross collateralization, I think is crucial for the industry and will be a huge leap forward for us once we've solved that efficiently.
Okay, thanks a lot, Anton. You're doing off-balance sheet market making, right? So you don't really have that concern, do you?
Yeah. So indeed, just to explain, I mean, the comment that you made is so that we actually operate in Swiss language as a portfolio manager. That means we either run things through managed accounts or through SPVs. And in that context, we have an investment product that professional institutional investors can invest, which is a structured product, an actively managed certificate. And then we pull that capital and then deploy it on exchanges to trade and provide liquidity. And kind of in that context, to throw a spanner into the discussion, just many times when we would onboard an exchange and then tell them, okay, we'll now deploy our algos and let's start market making, and then tell them, yeah, by the way, but there's an investment product, that will actually have to onboard as well, and that's where the capital will be sourced from. I would have to say I was quite surprised, by the confused looks on people's faces when we tell them that there's actually another thing that holds the capital that we actually use for trading and shuffling around. So I have to say I was quite surprised by that. I mean, Patrick, you come from the finance world as well, so you know the Swiss scene, so you know these products that are kind of quite typical in Europe and in Asia, not so much in US, and kind of to have the lack of understanding coming from the compliance side mostly, actually, in terms of what do we want to onboard, what do we want to use, why we do it off balance sheet, why we're not a prop shop like pretty much all the other players. So this is kind of, I have to say, this was for us huge challenge, and also just it restricts actually where we can operate because people just don't get it. What is it we are trying to do there? And there's, given the skepticism around in the crypto world, kind of what people are trying to do, that was it's quite a bit of obstacle for us going forward. Even though in theory the idea is really great, if we need more capital and kind of that you cannot easily do if you operate as a proprietary trading firm, well, we can just top up and get more AUM in the investment product. But then kind of leveraging that in an efficient way across all these digital asset exchanges or platforms, that's been actually a huge challenge for us going forward. And this also explains why we don't do OTC trading, because again, how would that work in that context? Who would onboard with whom, and how would that work? It's actually quite a bit of an issue at the moment for us. But again, it revolves around what was mentioned before, educating both the people from traditional world and also our world as well, how things potentially can work, and how we can leverage actually this capital that's sitting in the product actually, because it actually can always be put in good use. So this was kind of my background.
It's quite interesting that the word regulatory or compliance was mentioned a few times, and that's then one of the last topics we're gonna hop onto. But it seems to me one of these hurdles that is also hindering the balance sheet expansion for you guys, for companies like you in the market making space, and as well what Jacob said from GSR, that finding the right partners to move around your capital is quite essential. But then if you let's say if you are a regulated player or you want to become a fully regulated player, then you need to choose your partners wisely. Otherwise, you run into troubles there again. So it is a very delicate game or situation you're in, that you expand your liquidity or your balance sheet, but make sure that you stay within the regulations. So that's quite interesting. And now, regulatory thing aside, I would like to hear some of your takes about centralized exchanges versus decentralized exchanges. I'm not quite sure who of you guys are also doing some liquidity providing in decentralized exchanges. I know you all do it on centralized ones. But what's your take there about the liquidity that is sitting around in these decentralized protocols?
Yeah, we're quite an active participant in that space. I think it's helpful though to kind of break it down, because I think we can probably categorize DEXs into the three segments. First one being sort of fully on-chain order books, where both the matching and the settlement happens on-chain. And I think like IDEX is probably like a good example here, like the kind of first generations of decentralized exchanges. And then the second category is sort of the what I think of as kind of like the sort of next gen, or the step up, where you have like the trading and order matching happening off chain, but where the settlement goes on chain. And all the kind of 0x exchanges or relayers are in this category. DYDX, Derivadex is a new exchange, I think, doing this as well. There's a few others out there. And then thirdly, AMMs. I think this is probably where it's this probably is the area where we've seen the most growth, especially over the past 6 months or so, with the DeFi boom we've seen during the summer. Like Uniswap is doing 200-300 million per day. I think at one point was doing more than Coinbase. And so it's definitely a market which is very hard to ignore. But the thing is, like, market making there, right? The whole concept is flipped on its head, because by depositing assets, you're a liquidity provider, you are a market maker, right? And where prices are set deterministically by the protocol or by the bonding curve. And so the role there of a market maker is very different, right? It's much more about like whether or not you want to take that kind of impermanent loss, and whether you think that the kind of accrued fees over time make up for it. Now, given that most AMMs we've seen that pop up, right, they incentivize and somewhat subsidize that through issuance of their own token. That's probably been like the lowest hanging fruit for anyone that can partake in that space, where yields are insanely high. There's been a lot of profit to capture there. But I think if you zoom out, right, because AMMs, like, prices are set deterministically, there is a big opportunity set to sort of act as not necessarily a market maker, but a taker, and sort of keep prices in check and in line with centralized exchanges, where and when arbitrage opportunities present themselves. And if we look at on-chain data, at least in the major pairs like ETH to USDC or ETH to wrap BTC, like most of those prices or most volumes that go through those pairs, I'd say something close to maybe 80% or so are driven by arbitrage across or against centralized exchanges anyhow. And we also have the rise of kind of flash loans, where you can sort of package together trades and bid for block space through priority gas auctions. And it's sort of like, it's the sort of DeFi equivalent of high frequency trading almost. But I think looking at that space, right, if you look at something like a Uniswap, the breakdown of volumes, it's very sort of, it's very skewed towards kind of tail end of assets, where kind of smaller altcoins there's a consolidation of liquidity there. And so I don't think that, these kind of bonding curves, or these kind of simple bonding curves, are going to replace centralized exchanges in the stuff which really trades, like ETH and Bitcoin and whatnot. But rather, these are going to exist as sort of separate ecosystems. But it makes a lot of sense for stable coins or kind of long tail assets where liquidity otherwise would be kind of pretty dispersed across many small exchanges.
Thanks a lot. Regulatory wise, how you guys see that, or the others? I mean, interacting with a DEX isn't that problematic for you, or does it not matter?
I think for us, it kind of depends again on where you're domiciled. For us in Singapore, we're in the midst of the PSA licensing, and there's some certainties that come with that, and more questions opened up as well about how you create auditable trails and how you account for this on your books. So while we have been an active participant, we've also taken the steps to mitigate and manage certain risks there. It's been very opportunistic. I think to what TT said, stables and some of the more esoteric tokens where it makes sense to deploy your flow there, but not a wholesale strategy because it can get messy fast too. So we've been careful with some of the tests and some of the balances we've put towards DEX market making, but as the volumes have grown, it's also become very hard to ignore. So I think it'll become a core part of what we do in the longer run, once there's a clearer picture of how to properly report.
Yeah, fully agree. Thanks.
Yeah, I'd second that. We've had a similar approach. I think educating ourselves in the space has been very important. Assets in DeFi, I think depending on how you look at it, is today somewhere around $15 billion versus in January was $500 million. So it's hard to ignore. I think that what TT alluded to on the sort of reward side, I personally don't think it's sustainable just to give away freebies for someone to stake tokens. There needs to be an evolution of decentralized finance where these rewards become smart rewards or sustainable rewards. And I think building out a derivative, potentially being able to build out a derivative or conditioning reward in decentralized finance might actually help that evolve more. So we are staying, we're staying close to the space. I think for the large tokens, as been said before, probably a central limit order book makes sense. It's tried and tested. We don't have to. It's also where the institutions will tend to want to come in, and that's how they understand, trading, if you like. And from a regulatory perspective, I think Joshua was mentioning a very good point. Being able to book trades and account for trades accurately is instrumental for a firm like ours that are pursuing sort of the regulatory route in the space. But once that's been solved, there's no reason why we couldn't scale up engagement in decentralized finance as well, or decentralized exchanges as well.
Thanks a lot.
Yep.
Anton, on your side, that's not really a thing, is it?
So yeah, I can confirm that the capital from the investment product is not touching anything that's on chain at the moment, and that's the working assumption going forward. What I do have to say is what we see, actually, it's not in the current projects and protocols, but what I anticipate actually that going forward, that we might see actually infrastructure becoming the liquidity becoming part of the infrastructure within a lot of these projects. Yeah. So what we see is actually with the upcoming decentralized exchanges, they really want to integrate the liquidity mandate rules actually directly into the protocol and mandate how you would market make. Yeah. So this is just for me actually quite an interesting evolution, because usually it's actually the opposite. As a liquidity provider, market maker, you want to have as much as freedom as possible to manage risks. Yeah. what we kind of see is actually certain projects going in the opposite direction to really make market making and liquidity conditions as well part of the infrastructure of the protocol itself. Yeah. So I think this could be actually quite interesting things going forward, and this might be interesting for Floftic as well. In terms of the automated market making protocols, I have to say that very much remind me of something called small order execution systems that existed in the 90s in the US equity markets, which kind of basically, demanded, how you quote, which was basically predetermined. And kind of, not to go into details, people can read about it, but basically the market makers who were participating in the programs were arbitraged like hell, nonstop. And people who were, arbitraging, and they even had a name. They were called the SOES bandits because it was so popular to arbitrage market makers who had to quote at predetermined prices all the time. And this very much reminds me how the AMM protocols are set up actually. And that in that context, I agree actually with the previous statement, is that when you have predeterministic formula, how you quote, that will just not work. You'll get arbitrage the whole time. So the two things you don't want to disclose to anyone is how you manage your risk and how you price things. Yeah. And this is exactly kind of one of the two, actually, the automated market making protocols disclose. So I think that will not fly going forward. And they will have to change in that context. Yeah.
Thanks a lot for that. Maybe on the AMM side, we also got a take on this as well. I believe for smaller coins, there is quite some added value to have these automated market making pools, because you're not gonna get proper price discovery on centralized order books. And I was even thinking of the bridge into the traditional finance sector, all these very small cap stocks that banks have to quote but don't really like to quote, and the customer gets always a rip-off price because no one really wants that risk or quote these stocks. If you could set up AMM protocols for these very small cap equities, that might be something that could fly in the end. But that's just forward-looking for the next 5 to 10 years. Now, the last topic, the regulatory environment, which we actually covered quite a bit already, but we also have some reviews on our desk that we go through counterparties over and over again, see if we feel there is some risk, especially some regulatory trigger risk, that we should move the capital away or should divert trading to another platform. And I was especially sort of hit by what happened with Huobi and OKX. Maybe it's not directly related to the platform itself, but to senior management, which then sort of triggered freezes of assets on these platforms. And I just want to get some your insight or how you feel about the space. I know that Singapore and Hong Kong especially, they're pushing for these more regulated environments and companies, which I really like because it will bring this space forward. But how you evaluate these issues or these risks you probably make markets on these platforms?
Yeah, I think the short answer there is that effectively in crypto, given how relatively early and nascent the space still is at large, you just have to go to sleep worrying about all your balances, all your positions all the time, because you never know when something might happen. This is it's unfortunate because most of the venues where liquidity is deepest and trading is the most active are also the exchanges which have kind of taken the approach of sort of regulatory arbitrage. But yeah, I mean, but with that said, like you also have to, like, it falls on this sort of you have to think about where you want to be on this sort of risk spectrum, right? As in, if you go and trade on a small kind of unknown exchange where you don't have a communication channel with them, you don't know where they're based, you don't have any operating history. There's no insurance fund. Even if like prices are super wide and people are crossing a bid offer, like is that worth kind of the risk? What kind of worth it against all these other risk factors? Maybe not. But if you look at kind of other like larger venues, whether it's an OK or a Huobi or a Binance, I think the fact that they do have kind of operating history and they've been through ups and downs over the past couple of years, that provides some sort of trust backstop, so to speak, at least. Yeah. I think, obviously there are newer venues out there which are going to focus kind of just on, let's say, the professional investor crowd, like exchanges which are, kind of super regulated, that maybe only offer products to accredited investors. I think the broader question there is more around like whether or not there's gonna be any activity there, that's worth really pursuing. Because as a market maker, you're not a market maker because it's fun, right? We're not putting up prices because we want to, or rather because we have to, but it's because it's an activity which it's a strategy alongside sort of other trading strategies, and so with the rise of the sort of fiat on-ramps and whatnot, just kind of given how easy it is to enter the space, it also lowers the friction and the barrier for people to come into the space, into the sort of crypto native ecosystem, which broadly is still unregulated. And so I think in the near to medium term future, I don't think that the kind of more regulated venues are going to see that much pickup versus the incumbents. Like we have seen like CME, and it's grown, and there's also now Backed and Ares X and a few others, but at the moment the volumes there are nowhere near like what Binance or Huobi or Deribit do.
Thanks a lot.
Yeah, I don't know what sleep TT was talking about, but I think to his point, it's exactly a whole new host of questions raised by the regulations, right? And devil's in the details here. It's kind of interesting how which functions have grown in our businesses, our respective businesses over the last year or so, right? Like our compliance, mid back office team is the size of like a fund that might manage a few yards, right? It's grown and grown, and it's obviously there's just a lot of operational work to do there. But that's also because like, we're seeing regulations come out that require an efficient deployment of travel rule solutions, and I don't think anyone really has a fixed idea on how that's going to work. There's a bunch of competing solutions out there for that right now, and also for us, like dealing with non-custodial wallets or exchange wallets, there's a whole host of different rules around that. And again, that's relevant to our business more on the OTC side. So I think putting in place more strict and more closely followed measures to manage balances on and off exchange and those risk limits with clients has been the number one thing. That's made a big change in the way we interact with our counterparties. But also it's impossible to ignore, as TT said, some of the large exchanges, regardless of what's happened in between. And relationship is everything here. So I don't think that you can create a smarter way to predict who's gonna get hit next. I think you can only just improve your relations and make sure there's really clear lines of communication there.
Yeah, absolutely agree.
Yeah, I think, at GSR, we operate as though we were regulated. We, obviously, like I think most firms in this industry do now, they have, proper KYC and ALM processes for onboarding, which I think is very important. You need to make sure that you know who you're dealing with, and likewise, we produce our own KYC and ALM material to those who ask to onboard, who asked for them as well. I think it's important that we are a trusted counterparty. We've been part of launching the first self-regulatory organization in the US called ADAM. But the real purpose is that regulation does two things. First, it's designed to protect consumers, and two, it's there to create a level playing field. GSR, being programmatic trader, we're rule-based in the way we work. Having a level playing field is very important. That having the rules is very important for whether you're in HFT or systematic trading or in market making as a service. And level playing field. I mean, and acting like a regulated means no wash trading, no front running, nothing like that. No spoofing, all of those things. And at the end of the day, it's the retail customers, the consumers that get done on these. We can obviously see very clearly where there's wash trading going on in particular tokens. It's sort of an open book for us because we have our own algorithm in there. But the market itself needs to grow up, and moving forward a few years, we are big believers in that the options and the derivative space will grow significantly, and that will create a more mature market for people to take more structured risk exposure and more tailored views, and we'd like to help them with that, and that will open up for more institutions to come in, as we're seeing these prime brokerage services, but they will need a regulated market to trade on. And our firm is set up to sit in the intersection between those two traditional markets and the new digital asset market. So we're pushing very hard to welcome regulation, and I think it's needed for the space.
Great, thank you.
Yeah.
Anton, yep.
Yeah. So just on my side, I mean, also coming from a Swiss perspective, I think this is the point also as well why Floftech operates off balance sheet as a portfolio manager, because at least in Switzerland it's kind of like the most progressive legislation, but also quite strict. As you kind of know, it's like putting assets on your balance sheet can even trigger a banking license in certain cases. Yeah, so that's not feasible for a digital asset startup to go in that direction just to provide market making service in that context. Yeah. So I think, also reflecting on running an exchange kind of so far being highly regulated or wanting to be highly regulated in terms of the hyper growth that certain exchanges had was just a losing proposition. If you really went down that direction, meaning it meant actually that you were just left out, actually. I mean, all the kind of successful stories that I saw on the exchange side were the ones who really operated offshore as long as they could, actually. And kind of in light of that, what we see is that the regulation will really matter, and very soon is actually when we're talking about security tokens. I think really then the game is completely different, and then that will be actually a trigger why certain players might actually want to become highly regulated if the opportunity becomes big enough, which I still think is a year and a half, maybe even more too early in the context of the security token space. Yeah, but this is kind of what Floftech has been preparing, that actually when that moment comes that we are ready and we have a kind of clean books actually from the first days, that we can offer services both for the security tokens. But kind of looking at the pure crypto space, I don't think actually that the exchanges that will go in the highly regulated space will actually benefit at all in terms of user acquisition.
All right, thanks a lot. We got a few questions from listeners. I would just shoot it at you guys. Some are derivatives questions and some are some regulatory questions. The first one is, how do you measure the skew of options and other measures tracking options and futures activities, and how does it affect your operations?
Yeah, I guess I can take it from GSR perspective. We have an internal risk library which is pricing derivatives on most assets, most digital assets, not only the one that are listed on exchange. And I guess we do measure the skew from from what we can see on Deribit, and obviously Skew themselves are producing some analytics on that, and it helps us to it helps us to price some of the risk that we can offload on the screen. But more than that, I think that we have a more full picture internally, and we can price options on almost any assets, and we can do it on different tenures, not just the rateable options that are in or the bullet options that are on the screen. So I think it's very important to have your own view of the option of the surface across different assets, and it helps you deliver treasury services or hedging services or yield products to your clients.
Thank you. Anyone else? Another take on it?
Yeah, maybe I can add a bit on the future side. So I think the shape of the futures curve matters a lot to us, and anyone that's sort of active in the basis the basis trade, which simply put is buying a spot instrument and selling a future against it, or vice versa. And so the shape of the futures curve and kind of how steep it is across different points matter a lot, because they signal and sort of an implied funding rate in the market. And so, for example, if someone comes to you and they want to lend you tokens, what would you be willing to bid on that loan? You can get an implied rate from the market by looking at where the market implied yield is, right? And so, right, if you have dollars and you buy spot and you sell futures against it, and you carry them into maturity, and that yields you, let's say, 15% per annum, maybe you're willing to pay 12% on the loan, or maybe 10% or whatever. And so this also matters because when you're quoting, let's say, OTC prices, streaming prices to client on post-trade settle, when someone comes and takes risk from you, you have to go and turn around and find a way to hedge that risk. And very often, the most liquid hedge is in a perpetual swap or a derivative. And having an understanding of what the implied rate is on that balance sheet can help you kind of adjust the price accordingly depending on your settlement period, right? So if someone buys Bitcoin USD from me and they settle in 2 days' time, when I hedge that risk, unless I have the other side, I'm spending my precious balance sheet, which is paying an opportunity cost, equating to 2 days of whatever kind of implied funding is in the market. And so, and equally, let's say in that same kind of simplified example, if I'm hedging with futures contract, maybe I have a model which says, okay, on average, the relationship between the various curve points looks like, in whatever way. And maybe in this exact moment, according to my model, this point on the curve is a bit mispriced. So I will hedge with that instrument as opposed to another instrument.
Yeah, thanks a lot. So goes more into the relative value trading sort of thing than if you choose different points on the curve. Cool. There is another question. Goes to everybody again. Which platform you recommend to buy BTC with a leverage of 2 to 3? How much is arbitrage across exchanges critical to you, and what do you do? I think on the arbitrage side we covered quite a bit, but maybe that guy just wants to know what's your favorite exchange to buy some Bitcoin. No one? Okay. The last one is, how much is wash trading still a problem in today's market, and what are the effects of it in your operations? Some of it we covered on the GSR side. Jacob, you have some add-on comments?
No, I'd say it's still hugely prevalent in the markets. It's used as a marketing and promotion. Still being able for token issuers to show big volumes is still very important, and for exchanges as well, to show big volumes. That how they get user acquisition. So they are incentivized to to do that by any means necessary, which creates a lot of wash trading. How does it affect people? Well, you can imagine a scenario where you look at an order book and you look at volumes. So let's say you go in and you look at volumes for a particular token that looks extremely liquid. So you decide to go in and buy some of that tokens, but when you go in and buy it, the price just disappears from you. And similarly, if you accumulated a big position, you see big print of volume, you try to get out of it, but you just rip through the order book because all the volumes that you see is fake. So there's no integrity in the market, and that's a huge issue. Does it? When it doesn't particularly hurt GSR, we can see when people are wash trading and they are trading with themselves. It's not a particular issue for us, but for the market as a whole, it's hugely disruptive, and it's something that we need to get rid of, I think.
Yeah, totally agree. Yep. The way it might affect market makers is when you have a client who maybe isn't just so familiar with these activities, who has a very different picture of the token he wants to trade, and the way it affects us is how much time we spend trying to explain to people that the picture they see isn't exactly realities. Yeah, I agree. We need to get rid of this.
Yeah, agreed as well. Another question to all panelists: will markets get a lot more efficient if traditional finance companies, in brackets Wall Street, enters this market, or will they be unable to catch up? So I guess more money, more capital flows in. Does it get more efficient?
I think traditional trading firms and institutions are already in the space. It's maybe just that not all of them are as public with their activities, but within traditional finance, the kind of larger high frequency trading firms and market makers, they've all been active in crypto for many years already. And so I guess this goes back to the earlier question on kind of arbitrage and sort of market efficiency. Obviously a lot of the kind of simple arbitrage is already gone. Of course, there is still arbitrage one can conduct, but it's very either fee sensitive or latency sensitive, where maybe an arbitrage that you see is not an arbitrage that a second person can act on, because you have different fee tiers on exchanges. And so yeah, the market in that regard is already extremely efficient, but of course, like as more participants enter the space, that efficiency probably kind of goes up as well.
Maybe just to add this on my side, I think that how much can you arbitrage or take advantage of the inefficiency or opportunities will very much depend on the infrastructure, which we touched upon, just in the previous questions. So do we have that simple ways of managing the treasury? Do we have off-exchange settlement, off-exchange clearing? And these are kind of the things, in my view, that will enable, can you capture this opportunity or not? Not so much the big money trying to enter the crypto world.
No.
I agree. I think that the market are more efficient than people think. There's a lot of people looking at the crypto markets and thinking it's ripe opportunity for them to go in and deploy some generic algos and be profitable. And they soon discover that there's actually it's actually quite a competitive market. I also don't think that I also think that you can't underestimate the infrastructure that you need to build up to be able to trade in the crypto markets, to be able to access the fragmented liquidity and understand the different, the different trading venues. There's a lot of inside knowledge that's very valuable that few firms has built up. Third thing that is very important is that you can't just download data and do your research. That data will be absolute garbage. So the real gold dust that you have is your own tick data and your own fills that you've collected over years, and that teaches you to understand the market microstructure. And to do programmatic trading in crypto needs to be fairly short term, just by virtue of the fact that the markets doesn't have, a long history of data. There's no factor investing that would have any degree of sort of statistical significance if you would deploy them. So having the right data, having the right integration, being humble towards the towards the opportunity set in the market, and do rigorous research, I think it's the way forward. And as the other participant has said, there are a lot of very, very respectable firms that you are competing with in this in this space, in addition to the other people in the panelists here.
Yeah, to quickly add on this as well, I think it depends on the state of the industry. So if we think of participants that are kind of non-trading firms, non kind of market makers, if they were to come into the space in this current setup, right, I think it's pretty hard to imagine, an unconstrained or rather a non-unconstrained or a constrained player, like a regulated market participant, coming in and buying blocks of like $100 million spread across like six different exchanges. But if someone like a MicroStrategy comes and buys, everyone knows where that flow is going. And, I would say this is like traditional money by all means. And so if anything, it can even create greater market inefficiencies. If that flow all goes through Coinbase, we probably should have a bit of Bitcoin sitting on Coinbase, just so that if prices there overshoot, one can lean into the offer and then go better bid on other exchanges and so on. I think it depends on what constraints these players operate under. There are certain venues maybe they can only execute on, and that could that could alter sort of the microstructure and sort of what opportunity set is available. Yeah,
fully agree. I think, or if I take it a step back, if I look at pure retail guys, if that is a question from a retail trader, I think they believe that market inefficiency is high volatility, sort of saying if the market moves up and down 10-15% a day, then the market is inefficient. Or they're just making the assumption that, like the markets we know in traditional finance, they have all backstops, and equity cannot rally more than 5% and cannot drop more than whatever percentage. They have circuit breakers in it. So people are not used to the volatility crypto has, and then make sort of that falsely assumption that it is not efficient. But I fully agree with you guys that the firms that are in it and doing market making, they're highly sophisticated, and the market is already very efficient, and it's not that easy just to make money with let's say a cheap algo back tested a few years and then run it and be a millionaire. That's not going to happen. I know that.
I actually think TT was onto a very good point. Currently, the market is kept efficient by having very technical traders, micro market structure trader in there. But efficient market has all to do with random. It has nothing to do with volatility. It's all to do with randomness. And an efficient market is completely random in its price. So there's there's no stationarity in the way that you can discover serial autocorrelation or but we can definitely see some degree of serial autocorrelation in these type of market. It's just that they move in terms of speed, and it's hard to capture, and it's a high risk to try to trade them. But once you get people in that have different ways of investing, you don't just have the market makers, you also have the hedgers, and you have the speculators in anomalies, because different people have different reasons to approach the market. Anomalies towards the efficient market hypothesis will start to will potentially present themselves, and we will create a more dynamic trading environment.
Yeah, and I'm very much looking forward to that, because I'm so bored of the traditional markets these days. I have to say. So there are no more questions. We're 5 minutes over. I thank you very much for your insights. It was very interesting to hear your takes. And thanks again for joining. Thanks a lot.
Thanks for having us.
Pleasure.
Thanks
Thank
for
you.
having us. Cheers. Bye-bye.